Hello, welcome back to the channel. Something that I've noticed from a lot of new investors when they first set up their brokerage account is to ask the question, should I invest in either Amazon, Apple, or Tesla? These are the three most common names that always come up. And that totally makes sense. These are companies that we hear about in the news all the time. We have either direct or indirect exposure to their products and services, and they're just massive companies that everyone seems to have made money investing into. So it's normal to see new investors get attracted to these almost immediately as soon as they set up their brokerage. Now, I agree that Amazon, Tesla, and Apple are great companies, but the question about them being great investments, well, that's debatable. The only difference between a great investment and a not so great investment is the price that you're willing to pay for that. What I mean by this is that if you're looking at a company as someone who wants to buy the entire business, what valuation will you be willing to buy the business at? That's it. The price you pay will determine how good your returns are on that investment. The best example for this is actually Microsoft. If you bought Microsoft back in 1999, fundamentally, the business was good. It was making a good amount of money. But when you look at the valuation, the price that people were willing to pay for Microsoft at that time was absolutely absurd. Whoever had invested in Microsoft back then had to wait 16 years to break even on that position. Even though throughout this time, Microsoft never stopped being a good company. Anyone who had invested in Microsoft in 2008 has currently made 10 times their initial investment. It's the same company, just different valuations, means people get different returns. The original idea behind this video actually came to me from a video that Monish Pabrai had uploaded on his own YouTube channel, where he was speaking to the students at Peking University. I'm going to go over the example that he talked about in that video, and then I'll mention my own recent experience where an acquaintance was recommending a great business, whereas I was recommending a great investment to him. A quick preview, the great investment is up around 2x and the great business, apparent great business, is up around 15 to 20%. I don't really even think that his recommendation was a great business, but I guess that's something that's subjective. So in Pabrai's example, Pabrai was attempting to persuade Guy Spear into selling out of MasterCard and then buying into this company called Suntec. MasterCard is a globally well-known large business with some durable competitive advantages. They've been a dominant company and have a lot of patents and intellectual property that they can use to be a great company well into the future. Pabrai mentioned that Guy Spear had made a 10x on his investment in MasterCard at that point. And he was suggesting to him that he should sell out of MasterCard and buy into this new company called Suntec. Suntec is a very tiny company compared to MasterCard. Most of you may have never even heard of Suntec. Suntec Realty is a real estate and construction company based out of Mumbai in India. It's not a globally known sort of company or a brand, something like MasterCard. But what got Monish Pabrai interested in this company was that the valuation had been beaten down due to something called demonetization in India. Demonetization was an endeavor undertaken by the Indian government in order to curb corruption. What happened was that back in 2016, the government announced that the 500 rupee note and the 1000 rupee note would no longer be considered as legal tender. Essentially, they removed the two largest forms of paper currency out of circulation from a sort of economy that was largely cash-based. It was a huge blow to everyone in the economy. Immediately, the first companies that were hit were real estate companies and construction companies. In those 2 months, in November and December 2016, Suntec's stock had crashed by 30%. The entire company had a market cap of around $200 million or so. Now, this company, they had a bunch of finished apartments, they had land, and one could have easily just gone through, online and seen the real estate that Suntec owned. At that point, just one of the projects that Suntec had was in the heart of Mumbai, and it was valued at around $500 million. That's one project. They had 24 others. One project worth 500 million, and the entire company was selling at a valuation of around 200 million. And they barely had any debt. Pabrai owns 10% of the company, by the way. Back in March, when we saw the stocks around the world crash, Suntec was also crashing. Someone could have bought into the stock again this year, in 2020, at a valuation that was a little bit higher than what it was in 2016. If you were to compare Suntec in 2020 to 2016, Suntec is a much better company now as opposed to then. Suntec now has agreements in place with State Bank of India, and they've acquired a lot more land compared to then to develop new projects. It's a stock worth looking into. I would even argue that Suntech is a safer company than MasterCard. So what I mean by this is that there may be a lot happening behind the scenes at MasterCard that retail investors like us may have no idea about. This was also my train of thought with my own experience with the acquaintance that I'd mentioned at the beginning of the video. Back in March, I went and told this person, check out GameStop. It's a beaten down company with more cash than debt, and at that point it was offering a great value. Not only that, the new gaming console cycle was going to happen in 2020, and that would boost the revenues for GameStop. The best part about the GameStop proposal that I'd given him was that the valuation of the company was equal to almost the amount of cash the company had in hand. It's like someone offering you the opportunity to buy a house for $1 million, and inside the house you've got like a cash pile of $1 million sitting. Throughout March, April, May, all the way till August, the stock was at the same sort of valuation, around the $4 to $5 range. My acquaintance said that GameStop is absolute rubbish and that he would buy into Citibank instead. Citibank was also a beaten down stock in March. It had fallen 50%. In my opinion, it's impossible for the retail investor to have an idea about what really happens in these big banks. We all know about the banking scandal that was recently uncovered. There was also another news with like Citibank revealing that they had lost $900 million in some sort of scandal with Revlon. You can Google it if you're interested. I'm not going to discuss it here. But my very basic thought behind getting into the investment is that if you don't really understand the business, you should definitely not buy into it. Picking individual companies to invest into is absolutely not an easy activity. If someone has decided to undertake this activity of investing in business and buying individual stocks, then they should look for opportunities where you can really get a fantastic risk-adjusted return, rather than just, being a closet index investor and buying 30 to 50 blue chip companies and then say that, you're buying individual companies. This is just my opinion on the topic. Do let me know if you like the topic, if you have a different perspective about anything that I mentioned, and hope you like this video. Thank you for watching.